Hey everyone, so today we're going to talk about demand and supply. It's something I'm sure you've heard of many, many times, but now we're actually going to drill down into what this really means. And this is really important because it's really the foundation for anything in economics. So whether you're taking a micro class, a macro class, or whether you're taking some advanced economics class, it all kind of starts with supply and demand. Now, before we get into supply and demand, some definitions to note. There are things called, so we talked in the chapter 2 about what a variable is, and a variable is basically anything. Now, there are two categories of variables. There are stock variables and flow variables. I just want to make sure you understand what that means before we advance. A stock variable is a variable that has a value or a meaning at a specific point in time. I'll give you an example. If you check your bank account balance right now and it says you have $1,000, that's a stock variable. It has nothing to do with how much money you've made in the last year. It really is telling you what you have right now at this point in time, right? So an inventory would be a stock variable. How many units do we have on the shelf right now? A flow variable is a variable that is an accumulation of time, or it has meaning over a period of time. For instance, if you earned a salary of $50,000 over the last year, that would be a flow variable, right? Because it looks at a certain period of time, being a year. How much money did you make in that time? So it's not a big thing, but it's important to understand what those two things mean. Because once we start talking about supply and demand, you'll get to know that supply and demand, or quantity supplied and demand, are actually flow variables. So now you'll know what that means when I say that. Okay, demand. So demand at a very basic level is, what are people buying? What do people want to buy? What are people, consumers, firms, whoever, the buyers, how much are they willing to buy? And what you have in front of you here is the demand function, which is really the relationship between two things, quantity and price. We typically will put price on the y-axis, quantity on the x-axis, and it shows you this negative relationship because in order to increase the quantity that people want to buy, we call that the quantity demanded, you need to lower the price. If we lower the price, buyers will want to buy more, and that's what demand is. And vice versa. If you raise the price, well, buyers are going to want to buy less. So what are the terms you want to know? Quantity demanded, that is just the quantity that buyers are willing to buy. I'm saying willing, I'm emphasizing that because it's not necessarily what they will buy, it's what they're willing to buy. We'll get into what they will buy, how much they'll actually buy once we introduce supply, but it just shows you that at a particular point in price, so let's say here at $45, consumers are willing to buy 1 unit. If you drop the price, say to $5, maybe consumers would be willing to buy 50 units. Okay. So I just gave this one away, but do you think quantity demanded is a stock or a flow variable? Quantity demanded is a flow variable because the real interpretation of quantity demanded, let's say 45, right? There's a period of time attached to it. So demand could be for a day, for a week, for a year. So we could say, well, at a price of $45, consumers are willing to buy 1 unit per day or per week or per month or per year. There's actually a unit of time attached to the demand, which makes it a flow variable. You see, you have the full definition here. The quantity of goods consumers are willing to purchase at a specific price. I would even go further. I would add to this, and over a specific period of time. Add that in, guys. Add that into your notes. So it's how much they're willing to buy at a specific price and over a specific period of time. Sorry, my handwriting is not the best sometimes. And over a specific period of time. Okay, great. Now, the demand equation can be written in two forms. It could be a price demand equation, which is this one here, where it's price as a function of quantity, or it could be a quantity demanded equation. Quantity demanded equation, where it's quantity as a function of price. They're essentially the same thing rearranged. Okay, so just keep that in mind. One of them is price, one of them is quantity. Now, one thing that's really important is, and not just for demand, but for supply and for any other time where you have this concept of a graph, really a relationship between two variables, the two variables here being price and quantity, there are things that will shift the demand, meaning change demand, and things that will not. There's a difference between a movement along the demand curve and a shift in the demand curve. Let me just show you visually what I mean. If I go from point A to point B along the same demand curve, we call that a movement. But if something happens and the entire demand curve shifts, so the whole line changes, I'll call this D1 and D2, well, that is called a shift. So what you want to make sure to understand is, well, what causes a shift and what causes a movement? In the chapter on variables, chapter 2, I explained to you the concept of an endogenous versus an exogenous variable. So when you're looking at quantity and price, when you're looking at, the demand concept, the theory of demand, there's two variables, price and quantity. Those two are endogenous. Those two are explained by the model. Anything else would be exogenous. For example, income, a person's income. That's exogenous. It's not explained by the model. It's not here. The weather outside, exogenous variable. The population, exogenous variable. Anything that's not price and quantity is a variable that is exogenous to this theory. Okay, why is that important? Well, whenever there's an exogenous change, a change to a factor that is not basically price or quantity, that would cause a shift, a change to the demand. The idea is that if something like your income changes, then your demand will change at every price level. We're going to have a shift in the demand curve. And I've given you here a list of all the factors that you have to know. There's 5 really. Well, there's a few more, but 5 that really matter. Income. Now, if your income increases, there's 2 scenarios. Some goods will actually shift to the right. Now, a right shift is an increase. You want to associate that. A shift to the right is when demand increases. So when your income goes up, your demand for certain goods will go up. But your demand for other goods will go down. And that would be a shift to the left. We call them normal goods if you want more of them as you make more money. For example, if you start making more money, you will go to eat at a restaurant more often, right? That is a normal good. But if you make more money, you likely will buy less frozen dinners. More money, less frozen dinners. Because frozen dinners would be, in this case, an inferior good. And that's the definition of an inferior good. A good that as you make more money, your demand for those things goes down. Okay? Now, as far as price and quantity, we'll talk about that after we introduce the equilibrium. For now, let's just focus on the shifts. What causes your demand to go up and down? And honestly, this is really, a lot of it is intuitive. Just think logically. If I make more money, my demand for certain things is going to go up, and my demand for other things will go down. We call those normal and inferior goods. Price of complement goods. So a complement good is a good that you can, complement goods are goods that go together. So think of gas and cars. Those are complements. The more cars you buy, the more gas you will need to buy. Okay? So as the price of a complement goes up, your demand actually goes down. I'll give you an example. If the price of cars goes up, okay, we'll say PC for cars. Price of cars goes up. Your demand for gas will go down. Why? Well, let's push this aside and really break it down. If the price of cars goes up, the theory of demand, remember what I said? Let me clean this up a little bit. Let's say this was the supply and demand for cars. And let's say the price of cars increases from, we'll say, 30,000 to 45. Well, what's going to happen? Your demand will decrease. That's the theory of demand. Okay, so that makes sense. So if the price of cars goes up, our quantity demanded for cars will go down. That's the theory of demand. And now because we're buying fewer cars, we don't need as much gas. That's the link. Because the price of cars went up, people are going to buy less cars. And because there are fewer cars being bought, less gas is needed. So if I go back to the rule, you can see here that as the price of the complement good goes up, like in this case, that would be the price of the car, your demand for gas will go to the left or would decrease. Now, a substitute good is the opposite. A substitute good is a good that you can buy instead of. So let's say electric cars and gas cars. If the price, again, let's say this is cars, this is gas cars. If the price of a gas car were to increase from 30 to 45, your demand for it would fall. So let's say price of, I'll put G for gas cars, GC. If the price of a gas car goes up, your quantity demanded for gas cars will go down. That's the basic theory of demand. So what are you going to do? Well, maybe you're going to buy an electric car instead. So your demand for electric cars, EV, would go up. You see the difference if I put them side by side? When they're complement goods, like a gas car with gasoline, then these two go in the same direction. But when they're substitute goods, like a gas car and an electric car, they go in opposite directions. This is what happens when there's substitute goods. So when the price of a substitute goes up, your demand will go up. When the price of gas cars goes up, your demand for electric cars will go up. So it'll shift to the right. People are going to want to buy more cars. I know I'm spending a lot of time on this, but I want you guys to really connect the dots here. It's really simple. It's really intuitive, like I said before. If the price of gas cars goes up, the demand for electric cars will go up. Okay. The rest of these are less important, but let's run through them anyways. Consumers' taste, trends, and what's in fashion and so on. Well, as something changes in a favorable way, then demand will go up. So if it becomes more trendy to buy an electric car, the demand for electric cars will go up. If it becomes less trendy to drive a gas car because of the environment, well, that's an unfavorable change in consumers' taste. Demand will go down, or will shift to the left. And then the last one, population, is kind of an obvious one as well, I think. The more there is, the more people there are in the country, as the population rises, well, the demand for all things will go up. We need more cars, we need more bread, we need more tomatoes. So as the population increases, you have an increase in demand, which is a shift to the right. Now notice all I'm doing here is talking about shifts. What causes a movement where we just go from one to the other? Well, I kind of talked about it indirectly when I was showing you guys, and I said, if the price goes up, right? Remember what I said before? If the price of a gas car were to increase from 30 to 45, we said that the quantity demanded maybe would decrease from 5 to 1. So you see, a change in price will not, and listen up, this is important. When it's the price that changes, because price is explained by this model, it doesn't actually shift the curve at all. You just move from one point to another. A change in an endogenous variable does not shift the line. It just moves us to a different point on the line. In this case, in the demand topic, it's price. The only thing that causes a movement is price. Any other factor causes a shift. So let's do a few practice questions to make sure that that's clear. A change in demand is said to take place when there is. So here the wording is important. Change in demand. Okay. This is a shift. So all those factors that I was talking about that would actually shift your demand curve up or down or left or right, those are called changes in demand. Versus this, which is not a change in demand, this is actually called a change in quantity. Demanded. So change in quantity demanded is a movement. Change in demand, whatever, I wrote that somewhere. And change in demand is a shift. A shift in demand, a change in demand is said to take place when there is movement along the demand curve, no. Shift in the demand curve, yes. It has nothing to do with supply. It's not a price or a quantity change. These are all movements. Remember, a price and quantity, those are endogenous variables, so they would cause a movement, not a shift. What is an inferior good? We talked about it. Remember, an inferior good is one that as your income goes up, your demand for it will go down. So a good that normally everyone consumes, no. A good that inferior people consume, not a thing. A good for which demand varies directly with household income or inversely with household income. The answer is D. It varies inversely with household income. Inversely means they go in opposite directions. By the way, when we get to these points, you should be pausing the video and trying to do it on your own. If the price of tea falls, so let's write this down. If the price of tea falls, and as a consequence, the demand for sugar rises, then we say that these are what? Well, what you want to do, what I always like to do to make sure that I get these right, is in between, I always like to put what's going to happen to the actual, to tea. Because the price of tea is what's changing, I know that the quantity demanded of tea will go up. The basic theory of demand. If tea becomes cheaper, people will buy more tea. And then I look at this relationship. They're going together, which makes them complements. Because people are buying more tea, they need more sugar to put in their tea. 4. Demand in a particular market refers to what? Let's go through the options. Only the quantity demanded by households at current market prices. I don't like the only households. I mean, you can have firms, the companies that are actually buying, so maybe not. The quantity purchased, no. Remember, I said it's the quantity that people are willing to purchase, not necessarily what they actually purchase. The quantity that is desired but not satisfied, nope. The entire relationship between quantity demanded and price, I like this. Because demand, when they say demand like that, it's not just one point. It's the entire line. It's the entire line. That's demand. A single point is not demand. That's quantity demanded at a particular price. 5, which of the following would cause a movement along? So we talked about this. The only thing that causes a movement in the demand for ski lift tickets would be the price of ski lift tickets. What causes a movement along a demand curve for a product is a change in the price of that product. So change in taste, no. An increase in price as the supply curve for lift tickets shifts to the left. Yeah. Let's look at the other ones. A rise in the price of ski boots, no. Careful. Although it says price, it's the price of something else, which is an external factor. Rise in average household income, no. Increase in the population, no. So it's this. We haven't really talked about supply yet, but if you've got your demand curve and then supply goes like this, in just a moment, we'll talk about all the factors that shift supply, because supply, like demand, can shift left and right. So if supply were to increase and the price were to change from, we'll say, P1 to P2, well, you would have a movement along the demand curve. Your demand curve, although your supply curve may be changed, your demand curve didn't. Then, and maybe that's confusing, but think about it. You have two things. And again, we haven't talked about supply yet, but really you have two things. You have demand and you have supply. So you can have certain things that happen that shift one of them, but it doesn't necessarily mean it's going to shift the other. It might just move us to a different point. So a shift in demand, like I drew, changed a shift in supply, shifted my supply curve fully to the right, but my demand curve stayed where it was, and I just moved from one point to the other. Okay? So let's talk about supply. Supply is not really that different. In fact, very similar in a lot of ways in terms of like how you want to think about it. So quantity supplied, or supply rather, shows us the different amounts that the suppliers of a good or a service are willing to supply, right? So how much are the producers willing to supply at different price points? And this one is upward sloping because as the price of things goes up, suppliers of those things want to sell more because they want to make more money. So that's where you get this upward slope. Supply is also a flow variable because, like with demand, it shows you or it tells you the amount that suppliers are willing to supply over a period of time. So this could be a daily supply curve. It could be a weekly supply curve, a monthly. There's a time frame underlying the supply. Like demand, supply can be written both as a price and a quantity function. And like demand, there are factors that will affect the entire supply curve, which we would call a change in supply or a shift, and other things that would just cause a movement. And here you want to think about it the same way. Remember what I said. A change to some external factor that is not price and quantity, anything else, would be a shift. So what are the factors that are going to shift supply? You have them here. Probably the most important one is the price of inputs. Inputs are the land, labor, and capital that go into making a product. And it could be anything, right? If you're making cars, it could be the metal used to make the cars. It could be the glass used to make the cars. If you're making electric cars, it could be the copper used in the battery, which is used to make your car, right? Whatever is being put into the product is an input. And so as the price of inputs rise, essentially as it becomes more expensive to buy the raw materials, supply will shift to the left. And remember that a leftward shift is a decrease. And that should be logical. Imagine you were making a product. Well, if your ingredients became more expensive, you would be making less of that product. So supply will shift to the left. Again, we'll talk about this once we introduce the concept of an equilibrium. Technology. As technology improves, so does supply. If you're making electric cars and there's like a new technology that comes out that makes it more efficient to extract the copper from the ground, which is going to be used to make the batteries. I'm making this up, but as technology improves, it becomes easier and oftentimes cheaper to make a product. And so suppliers are willing to increase their supply of that product. Taxes typically have a negative effect. Higher taxes make it less desirable for companies to produce. Subsidies are the opposite. A subsidy is like a reverse tax. A subsidy is when the government actually pays things for the consumer. A good example of that would be daycares. So daycares, let's say you have a daycare where the price is $60 a day. You put your kid in, $60 a day. The government will often pay $50 out of that $60. So for the parent, it's $60, but the government pays $50, so the parent only pays $10. So this is good for the parent, but it's also good for the supplier, for the daycare, because if it's only $10 to put my kid in daycare, you better believe that there's a lot of parents that are now going to want daycares. And so the supply of daycares will increase. There's going to be more daycares opening up because of this favorable environment where it's cheap for the parents to put them in, but the daycare is still making a bunch of money. So all that to say, guys, more subsidies, more supply. Price of complements in production, price of substitutes in production. To really understand that, you need to understand what a complement in production is. So a complement in production is a product that is produced at the same time. I'll give you an example. When you're making, if you chop down a tree, because you need lumber, right? So you're a lumber company, you need lumber, you cut down a tree. Well, yeah, you're going to get the wood from the tree, but you're also going to get the tree bark, which is a separate product. You might also get sawdust, which has certain applications. And the more trees you cut down to make your primary product, which is the lumber, the wood and planks, the 2x4s, the whatever, the more of these other products, these byproducts you're going to get. Those are complements in production. The more you make of one, the more you will make of the other. Whereas substitutes in production, it's the opposite. It's products that are made using the same resources. And so the more you make of one, the less you make of the other. Let's say you make clothing and you have a certain amount of fabric. And with the fabric, you can make shirts and you can make pants. Well, the more shirts you make, the less fabric you're going to have left to make pants. You see how, if you compare that example to the tree example, it's really the opposite. The more trees I cut down to make 2x4s, the more sawdust I get, the more tree bark I get. They go together, up together, down together. But with shirts and pants, the more shirts I make, the less pants I can make. See? Opposite directions. Right? Those are substitutes in production. So let's see what happens here. As a price of a complement in production goes up, we are going to supply more of any other good, of the complement, for example. If the price of wood goes up, what's going to happen? Well, first let's talk about the basic theory of supply. This is the price of wood, and this is the quantity supplied of wood. Well, if the price goes up, we're going to move to a higher point, because suppliers of wood are going to say, oh, wood is becoming more expensive, I'm going to make more wood. So the first thing that comes to mind is, okay, my quantity supplied of wood will go up. Now, as I start cutting down trees to make more wood, my supply of, I'll say, tree bark also goes up as a byproduct. So you see, because the price of a complement went up, the wood, my supply of byproducts, the other complements, goes up as well. Now, for substitutes, I'll use my t-shirt pants example. Let's say the price of t-shirts goes up. Well, the suppliers of t-shirts are going to want to make more t-shirts. That's, again, the basic theory of supply. T-shirts become more expensive. They become more desirable for the manufacturers. But now if I all of a sudden start making a bunch of t-shirts, I have less fabric. So what's going to happen forcefully is my supply of pants will go down. And that's what you see in the table. As the price of a substitute, the t-shirt goes up, your supply of pants will go down. And then finally, number of suppliers is kind of an obvious one. The more suppliers there are, the more supply there will be. Right? The more pizza restaurants that open, the more pizza will be available to the market. The more pizza will be supplied to the market. That one's a fairly straightforward one, I think. Okay, let's do a few examples of that just to make sure that it was clear. The term quantity supplied is the amount of product that, let's go through it, firms wish to sell at a given price during a given time period. I like this. That's exactly what it is. It's the amount that they wish to sell. It's not the amount that they will necessarily sell, but it's how much they're willing to sell at a specific price over a certain period of time. Number 2, a rightward shift in the supply curve indicates what? A rightward shift, remember, is an increase in supply. It's when the amount that suppliers are willing to supply increases at every price point. So a decrease in quantity supplied, no. It's an increase in the quantity supplied at each price. Okay, number 3, the movement along the supply curve, S, from point A to C. So if I move from point A to point C, notice how we didn't change lines. We stayed along that line. So the only thing that can cause that movement would be a change in price of this product. We're talking about light bulbs, so it would have to be a change in the price of light bulbs. So this would be an increase in the price of light bulbs. Now that you've seen supply and demand, let's put them together to form kind of the market mechanism. So remember that demand represents all of the demand, all of the units that buyers are willing to buy at a specific price, and supply represents all of the units that suppliers are willing to sell. And if you put them one on top of the other, you see there's a point where the two meet, and we call that the equilibrium point, or the market clearing. Sometimes we refer to this as a market clearing point. This basically just means that at this particular price, whatever is demanded by the market is also supplied by the market. So whatever consumers are willing to buy, that's exactly how much suppliers are willing to sell, and the market is balancing. Now, the market is not always at equilibrium, but it's always trying to get there. Now, there can be situations where we are either above or below it. So a point above the equilibrium happens when prices are too high. We'll call that P1. And what you'll notice when price is too high is that quantity demanded is low, but quantity supplied is high because of the individual theories. The theory of demand says if the price is high, people are not really willing to go out and buy these things. But for supply, it's the opposite. As price is higher, suppliers are willing to sell more. So you end up having a lot of supply, a lot of goods. So try and imagine there's a lot of merchandise available, but there are no buyers. So we call this a surplus. There is a surplus that is created when prices are too high. And what eventually happens, surpluses put downward pressure on price because eventually these sellers are going to get tired of sitting on this inventory. Say, okay, what good is this inventory at this high price if nobody's buying it? And they will eventually start to lower their price. And as they start to lower their price, the theory of demand and supply will kick in. Supply will decrease, or quantity supply will decrease, and demand will increase, and eventually will return to equilibrium. Now, when price is too low, you have the opposite effect, right? So when we're down here, it's the opposite. What ends up happening when price is really low, quantity demanded is high, but quantity supplied is low. You have a lot of buyers and you don't have a lot of sellers. This is what you call a shortage. A shortage puts an upward pressure on price because you want to buy something, but it's not available. So at some point, the buyers are going to be increasing what they're willing to pay, and the suppliers are going to start increasing the price. It's like when there's a shortage in the housing market. A shortage in the housing market, there's a lot of buyers, there's not a lot of sellers, so the sellers start to raise their price. And eventually we go back to equilibrium. And that's why I said earlier that the market is always trying to get to an equilibrium. And whenever it's not at an equilibrium, there are forces that are putting pressure on the price to either go up or to go down. So I think I talked about all this. Oh, I already had a graph. Okay, that's fine. So let's do a few practice questions on this. So at the market clearing price for a commodity, at the market clearing price, so at the equilibrium, prices will remain unchanged even if there's excess demand. No, I mean, if you're at the market clearing price, there is no excess demand. So A is a trap. There may be excess demand, but not excess supply. No, at the market clearing price, there is no excess demand. Excess demand is when there's too much demand, or excess supply is when there's too much supply. When you're at the market clearing price, there is no excess at all. Shifts in supply or demand will not cause price change. See, this is wrong as well. We've already talked about shifts. So now we can kind of go back and talk about those last few columns. But before we do that, let me just show you something. You've got your supply and demand. If there's any external factor that causes a shift, so let's say we're here at the equilibrium, and let's say this equilibrium price is $100, and at that price, quantity demanded and supplied is 100 units. And then something happens. Let's say there's an increase in income. Okay, well, we learned that an increase in income would cause a shift in demand. Okay, so let's say demand shifts to the right. Well, the equilibrium point is no longer here. Now it's here because your demand is now at D2. Supply hasn't changed. Supply is still at S1, but demand is at D2. So your equilibrium price has gone up maybe to 120, and your equilibrium quantity has gone up to 120. So what was it saying? It said something that was wrong. Shifts in supply or demand will not cause a price to change. It will, definitely. The quantity supplied for a commodity equals quantity demanded. That is the definition, basically, of an equilibrium. But let's go back, okay? So now that you guys understand this, there's something else I need you to understand. As your demand increases, price and quantity will always increase. And I don't really need you to memorize this. In fact, I prefer if you didn't. You may end up memorizing it, but I don't want that to be the effort you make. Just draw it out. Look, if you forget what I'm saying, don't guess. Draw it out. Say, okay, well, I've got demand and I've got supply. Okay, what did he say? If demand goes up, just draw it. And you will see immediately, oh, wow, okay, yeah. I go from point 1 to point 2. So that's both an increase in price, because this went this way, and an increase in quantity. And the same is true. If demand were to go down for some reason, so that would be a shift to the left, you would have a decrease in price and a decrease in quantity. So this is the effect that a shift in demand has on price and quantity. And that's what those two columns told us here. I don't need you to memorize these. Just draw it out. If you know the shift, trust me, if you know the shift, you don't need anything else. Just draw the shift. Everything else will be staring at you right in the face. But supply is kind of different. You will still be drawing it, but I want to show you. When supply increases, price actually falls, but quantity goes up. And when supply decreases, price goes up and quantity goes down. And you could, again, draw it out. Look, you've got supply and you've got demand. If you forget, just draw it. Shift demand to the left. That's a decrease. Look what happens to the equilibrium. If we go from point 1 to point 2, we increased on price. You see, we increased on price, but we decreased on quantity. See, when supply goes down, price goes up, quantity goes down. So it's just something to understand. And again, I just want you to draw it out. Know your factors, and this is the table here. Know this. For this, just graph it. Cool. But it is important to understand how certain things will affect the equilibrium. Okay, here we have this table. How many dozens of roses would actually be purchased if the price in the market were $10? So here we have a price of $10. You have a quantity demanded of 500 and a quantity supplied of 200. So this is what I was saying before. Just because the quantity demanded is 500 doesn't necessarily mean people will buy 500. If you go to the store and you say, I want to buy 500 flowers, but there's only 200 flowers available, well, how many will actually be purchased? 200. So whenever there's a difference between demand and supply, quantity demanded, I should say, and quantity supplied, the amount that's actually purchased will be the lower of the two. Think of my flower example. You go to the store and say, I want 500 flowers. If there's only 200, that's all you're going to get. But at a price of, okay, so this is a continuation of this. At a price of blank, there would be excess of 300. So an excess of 300 means that either supply or demand will be 300 units more than the other. So I can see right here that there's a 300 flower excess supply, and over here there's a 300 flower excess of demand. So one of those has to fit. At $10, so let's see, at a price of 10, there would be excess demand. Is that an option? It is. That's the answer. Okay, then you have this graph at a price of P3. So when price is there, I showed you guys what that means. That's just below equilibrium. So you have a lot of demand, but not a lot of supply. So you have a shortage here. There is excess demand, right? Demand is exceeding supply. And there's pressure for the price to increase. There's a pressure for the price to return to equilibrium. One thing that I always like to tell students and say this almost in your head all the time, the market is always trying to get to equilibrium. That'll tell you the direction that the forces are pushing it in. So D. At P1, here, because price is so high, there's actually too much supply. There's excess supply and downward pressure on price. So excess supply and a pressure for price to fall. So A. Suppose that supply for some good increases, supply increases. So you have to know how to read that. This means that there's a shift in supply. And simultaneously, demand decreases. What is going to happen? I love these questions. This goes back to what I was showing you here. So let's bring this in. Okay, here it is. So they're saying that at the same time you have an increase in supply, so you have this happening, and a decrease in demand. So you want to compare these two together. Well, look, both of them are saying that price will fall, which means this will definitely have a negative impact on price. But when it comes to quantity, they disagree. One of them, the demand, is pushing quantity down, supply is pushing it up. So we call this an ambiguous change. This means that quantity could increase, but it could also decrease, and it could stay the same. So when you have forces pushing it in opposite directions, you want to make sure that you don't give an answer that's determinate. So look, I'm looking for one that says a decrease in price, but an indeterminate change in quantity. For this next question, I'm going to show you how to actually calculate the equilibrium. From a math standpoint, it's very straightforward, guys. You just take the two equations, set them equal to each other. So like I've got quantity demanded and quantity supplied. I'm going to set them, and it's not minus. I'm going to set them equal to each other, and that's it. So bring this 10 over, becomes 240. Bring this 4 over, becomes 5p. Equilibrium price is 240 divided by 5, which is 48. So I know the answer is A, but just to complete it, you then take the price and plug it back into either one. So let's say we plug it into supply, 10 plus 48 will give you 58. You could have also plugged it into demand. Oh, wow, I did that too fast. So price was 48. Quantity is 58. So the answer is actually B. Okay, don't do that. Always read your question carefully. But what I'm saying is you could take the price and plug it back into either one. It should give you the same quantity. And that's actually a good way of checking that you didn't make a mistake in the math. I almost always do this. If I was writing an exam, I would always do both. Even if I'm wasting, let's say, 30 seconds, I'm basically confirming that my answer is correct if you get the same answer for both. 8. So this is the same demand and supply, so we know that that's the equilibrium. So what happens at $40? So let's draw this out. I want to encourage you to draw your graphs as much as you can. So we know that the equilibrium price is 48. They said, what happens at 40? 40 would be lower. You're going to have excess demand. You're going to have a lot of demand. So I'm going to get rid of A, B, and C because they all say either market clearing or excess supply. So we know there's too much demand here. Now, as far as how much, you want to calculate the gap between the quantity demanded and quantity supplied, and that would be the amount of this shortage. So you're going to take the $40. Whenever you need to do this, you take the price and you plug it back in. So we're going to plug it into quantity demanded first. So 250 minus 4 times 40. So 90 is the quantity demanded, and quantity supplied is 50. So there is a difference of 40 units. So there is excess demand of 40 units. Okay, this is the 90. This is the 50. The gap between them is 40. So that's it for the supply and demand chapter. If you have any questions at all, please don't be shy. It's a really, I know it's not super complicated, but it is very, very important, and it's the foundation for everything you're going to see in almost any economics class, okay? The next chapter we're going to be seeing, depending on how you're watching this, but the next chapter in the book is elasticities, which is based on this chapter. Okay, see you there.